Hey everyone, today on the Final Bar, our first live show of 2023. Happy New Year. We are going to take a bit of a step back and think about the big picture. What have we learned as we've launched this new year of trading? Overall, the major averages pushing lower. The S&P 500 down just above 3,800. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to a new year of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Hope you are all doing well, and welcome to another year of the Final Bar. We're going to continue our efforts to illuminate what's happening in the markets, to focus on the lessons of price and trend and momentum and breadth and sentiment and all of those tools that we brought to bear, hopefully successfully for you in your own portfolio in 2022. 2022 was a challenging year, but I have found in those challenging bear market years, they often provide the best opportunities to grow as an investor because bad habits you can get away with in a bull market tend to bubble up and be a real challenge in a bear market phase. So probably any issues in your investment process came to light in 2022. Let's see if we can kick things off well and plan for success here in 2023. And it's going to start with a focus on the overall market environment. Today, we have just a couple goals. First off, we're going to give you a market recap on what we saw today with, as I mentioned, the major averages finishing really at the lows of the day. Not a horrible day, but not a great day, certainly by any stretch. We'll talk about the fact that energy was up while everything else was down. And we will focus on some of the key charts we think you should be focused on here as 2023 kicks off. As we continue on, I just want to let you know about the upcoming discussions we're going to have. One of the great parts about StockCharts TV are the guests coming through, and a couple of things to highlight for you. First off, this coming Saturday is Market Vision 2023. Our friend Tom Boley at Earnings Beats does his sort of kickoff for the year every January, and I will be speaking there, talking about some of the charts that I'm focusing on. Julius DeKempener will be focusing on sector and asset rotation. Grayson Rose will be sharing some of the charts that are top of mind for him, and Tom Boley will be talking about his outlook for the year. Every one of us will be asked our projection for the S&P for the year. We'll be talking about sector leadership and laggardship. So make sure you check that out. Just look for information on Market Vision 2023. Also, Jeff Hirsch, the editor of the Stock Traders Almanac, his father, Yale Hirsch, really pioneered the idea of seasonality, really popularized it here in the U.S. We will have him on the show next Wednesday, January 11th, for a special longer form interview. We'll talk about sort of his outlook for 2023 and how seasonality can really come into play. Finally, the StockCharts Market Outlook Special is happening Friday, January 13th. I will be moderating a fantastic roundtable discussion with Tom Boley from Earnings Beats, Greg Schnell of Osprey Strategic, Miss Schneider of Market Gauge. It should be a lot of fun, and make sure you tune into that. It's coming up this next Friday at January 13th. Let's continue on our show today with our market recap. As I mentioned, the major averages finishing weaker. Really, the course of the day was not particularly strong, but sold off in the last hour, reinforcing the negative feel to the tape here on Thursday. As this is our first show of the new year live, we're going to talk about some of the charts and just how they've evolved recently, but certainly some weakness here in the short term. The S&P is at the lower end of the range, testing that 3,800 level, which we've talked so many times. From last May, we first talked about 3,800 being important because of the reaching that first Fibonacci retracement level. We'll look at a chart of the S&P here in a minute. But overall, just as a reminder, the S&P down 1.2% today. The NASDAQ composite down 1.5%. Pushing the way lower, leading growth stocks leading the way down overall. Mid caps and small caps about the same. No real difference there between the large cap space and the VIX going higher. So well above 20, we're up to around 2250. Bond markets overall sort of mixed with interest rates coming off through the course of the day. Long bond yields below 380, 10-year yields above 370, and the dollar index moving higher. The UUP, which is a bullish dollar ETF, which we track here on our market outlook or our dashboard page, up about 1%. And that dollar chart is an important one. When we get to our segment, first quarter charts to watch. The dollar will certainly be one of them. Commodities overall have been weaker, and I think that's one of those interesting phenomena we've been dealing with. While commodities overall have been weaker, and you see that with the case of the DBC, you see that with crude oil prices certainly moving lower today, a bit of a mean reversion on that trade, with crude oil prices actually bouncing higher a little bit. And gold and precious metals actually down. Gold down 1.25%, silver down over 2%. Gold has been one of the better charts here recently going into the holidays and certainly coming out of the holidays. So a bit of a retracement from that recent rally. Bitcoin overall still trying desperately to chip away back at those levels of resistance. 20,000 is a level we've talked about, a big round number that has served as support and as resistance. We are well below that, sitting below 17,000. Yesterday, we barely got up to that 17,000 level, but it's been pushed away yet again. So Bitcoin currently around 16,850 and Ether down 0.25% today. Let's focus on a chart of the S&P. Again, just since it's our first live show of the year, just to catch you up on where things are at. Kind of a choppy period over the holiday weeks. In general, holiday sessions tend to be lighter volume, tend to be less big significant moves. You don't have a lot of earnings. You don't have a lot of news flow. It's more of a natural time, a natural break in the markets. I read an article in the Wall Street Journal this morning saying, the Santa Claus rally technically happened. But if you have to phrase it as the Santa Claus rally technically happened, that was not much of a Santa Claus rally. That's not much of a power headline. So overall, sort of a meager Santa Claus rally, if that, sort of a choppy period in December. And the last week of the year was nothing really to get excited about. It was technically a little bit up, but not by much. So overall, I'm seeing the market sort of in a period of weakness. And my market trend model, which I update every Friday after the close, last Friday, the medium-term model switched from bullish down to bearish. So we're once again, for me, in a period where the long-term, medium-term, and short-term trend models are all negative. So does that mean that stocks can't go up? Of course not, right? Look at Ulta, which is making a new 52-week high today, right? So it can certainly happen. Doesn't tell you all stocks are going to go down. It tells you the conditions are more in a negative period, meaning to me, it tells me to focus more on capital preservation than capital growth, focus more on risk management than on getting exceptional returns. And that is when actively managing your assets arguably is much more valuable in a bear market phase, because you can go to cash, you can get defensive, and you can ride out periods of market instability. The reason why the S&P and the NASDAQ are down so much is because the growthy stuff, which has been struggling so much as of late, and I think that's what's weighing on these benchmarks. So the market trend model being so negative here basically tells me to stay away from the growth trade, to still be looking for opportunities in more value-oriented parts of the market, more defensive parts of the market. You're looking for stocks moving, you can find them in certain sectors like industrials and materials and consumer staples and energy even today, but just not in the mega cap growth trade that worked so well in 2021, not alive and kicking just yet. Now, a daily chart of the S&P is something we can talk about a little bit, just to briefly orient us to where we're at. And just to hit on briefly here, the 3,800 level is so important, right? We talked about that level first back here over 6 months ago, right? This was in May of last year. And even before that, right? When the market really started to sell off and we saw the signs of deterioration, the question is, how low do we go, right? Or how low do we potentially go? So it is immediate an exercise to look at the significant low and high. So take the March 2020 low, take the January 2022 high, look at that overall rally from 2020 to 2021, and look at what some potential pullback levels could be. That first projection to the downside is 3,800. And if you take a couple steps back from the screen and just look at the chart, you can see that what the S&P essentially did was sold off to 3,800. And from there, we've been basically chopping around and bouncing off of that level. We've overshot and undershot 3,800, but overall, we're kind of rotating around that 3,800 to 3,900 level over the last 6 months, right? So the market has reached an equilibrium level in some ways, and now we're kind of transitioning around that level. Over the last couple of weeks, we've literally been sitting on this key level of support. I think this chart can look constructive as long as we remain above 3,800. I think the chart starts to look pretty negative the moment we start getting below 3,800. So it's not lost on me that was almost the exact close today. We got down there on an intraday basis, right down to 3,800. And I'll be watching that through the course of this week and the coming weeks, certainly, to see if 3,800 can indeed hold. Now, on the other hand, we have the 200-day moving average just below 4,000, which is an interesting data point. The S&P's 200-day moving average went above 4,000 off the viewable side of the page here, mid-2021. Here in early 2023, we've finally gotten below 4,000. So that's a level of potential support on the upside. 4,100, of course, the highs from late November and early December. Just briefly hitting on a couple other charts if we can do it. This is an interesting one. This is looking at breadth, and this is a chart we've often brought up as we talk about breadth conditions and looking at what stocks, or how many stocks rather, are above or below their key moving averages. We have the S&P 500 at the top. We are looking at the percent of S&P stocks above their 200-day moving average and the percent of stocks at the bottom above their 50-day moving average. Look at how both of these are almost right at the 50 level. And if you look at the last week or two, it's literally been right at 50. So what this tells you is it's literally a coin toss. If you pick a random stock in the S&P as to whether or not it's above or below its 50-day moving average. So while the S&P has been hugging in that 3,800 level, testing potential support, you don't have a real clear signal, I would argue, when you look at the breadth conditions using this particular set of indicators. It tells you that it's half and half. It's 50-50. There's no overwhelming number of stocks above their 50-day like we saw in late November. There's no overwhelming number below like you saw in late September. Here, we're literally at a pause. And that's why I think when you think of this market, I think of it as this point as a bit of a waiting game. One of two things can happen. We have a break below 3,800, and these indicators start to go below the 50% level. The S&P gets above 4,100, in which case these will go very far above their 50% level, most likely. And whichever way you see that break, I think that will tell you a lot about what the first quarter, maybe the first half of the year may look like, because that tells you whether buyers or sellers are sort of taking control of this market, right? Whether you have excess supply or excess demand, whether fear or greed is overwhelming and driving stock prices. At this point, I would argue it's still a bit of a question mark. Now, another thing to think about would be volatility, and just looking quickly at the VIX. And this is a chart that, as I was sort of doing my year-end sort of thinking, as we were publishing a lot of our great year-end commentary. And if you missed the top 5 charts of 2022, or if you missed any of our great retrospective work from December, myself and a number of the StockCharts TV contributors all put out some really good year-end programming. So make sure you go to StockChartsTV.com and check those out on demand, or on our YouTube channel as well, because it was really, really helpful, I think, in this market where there have been so many question marks. I think it really helped me to think about those different takeaways, those different conclusions. One of the things we talked about here to wrap up our market recap is volatility. And the VIX for most of 2022 fluctuated between 20 on the lower end and 30, 35 on the upper end. This is what I call a volatility regime, which is when the VIX settles in to a particular range. And all you needed to do, now looking back, it seems pretty obvious, just buy every time the VIX dips above 30, sell anytime the VIX dips below 20. And if you did that simple thing, you probably had a rock star 2022, and you essentially picked out every major turn in the market. Now, the good thing about volatility regimes like we saw is that it's very clear cut, right? All you need to look is that range. The challenge is the volatility regimes are not permanent, right? So if you look back over time, every 6 to 12 months, we get sort of a shift in the VIX. And the VIX either shifts to a period of low volatility, shifts to a period of higher volatility. And I think that might be something to prepare for here in the first half of the year. For now, I see the VIX bouncing off of 20. And as long as that keeps happening, that suggests that volatility is overall low, but stabilizing. We start to get a VIX dipping below 20 as a market rallies. That would tell me that things are different. At some point, we'll be looking for a recovery in stocks. And for me, that would be one of the things that could mark it on this page. Think about how 2021 evolved with markets going higher on low volatility. I think it could be a really compelling signal to look for, but we are certainly not seeing that yet. We'll take a quick commercial break. We'll be back talking to you about the first quarter charts to watch. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. It's so good to be back live with you. Hope you had a great holiday season. We are planning some really cool things for the show here very soon, hopefully in the coming weeks and months. We have a brand new studio, which we are finishing up here very quickly. And we have a lot of great plans for the Final Bar. So stick with us, and we hope we can be a part of your investing journey in 2023. A couple other announcements before we continue on our show. First off, we welcome your questions. We're going to do a mailbag segment on tomorrow's show. on Tuesday, on Friday's show tomorrow. And then next week, we'll do one on Tuesday as well. We would love to feature one of your questions live on the air. And you can get your questions to us via email, thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. I saw that Larry Williams just published his Market Outlook special earlier this week. That is going to be a fantastic one. I look forward to reviewing. As I mentioned, a lot of our StockCharts contributors have done a great job in the last couple of weeks, publishing some great year-end commentary and outlook, starting to put out some outlook ideas for the new year. There's so many great ways that you can use StockCharts TV to better understand these markets. So go to StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. Continuing on with our show, the next segment is called First Quarter Charts to Watch. We thought with our first live show of the year, we could focus on some of the big picture takeaways. Again, in our end of year programming, we hit on the top 5 charts of 2022. There's a bit of an overlap for sure, because I think some of these are pretty key, like the S&P, like the dollar. But what we want to do here is focus on, now that we've gotten through this holiday season, now that a potential Santa Claus rally and all the fourth quarter stuff, the window dressing is all behind us. Now let's really look forward and think about what this market is going to be doing. By the way, this is in some ways a preview of the kind of conversations hopefully we'll have on our Market Outlook special next Friday, and also our Market Vision 2023 coming up this Saturday with earningsbeats.com. So let's start with a couple different charts. I want to focus a little bit more attention on the chart of the S&P 500. We'll talk about the dollar, and then we'll focus a little bit on relative strength. You know, we were talking about the S&P before the break, and we were looking at the daily chart. You know, when I think about the big takeaways, and again, when you're doing sort of a big picture thinking about the market, when you're stepping away from the day-to-day movements, the flickering ticks, as I call them, and thinking about the overall trends and the overall trajectory of the market, what you want to do is literally, and I'm not kidding, take a couple steps back from your monitor. Don't focus in on every pixel. Focus on the overall shapes and the trends. And this reminds me of my time at Fidelity in the Fidelity chart room. One of the great exercises we would do with clients in that space was say, okay, now we've seen the granular detail on these markets. Now take a couple steps back from this big wall and think about the overall trend. That was a great way to demonstrate the overall movement in equities. For hundreds of years, the equity markets have grown, right? And even well before we have good data to measure that. All the evidence points to the fact that equities grow because overall economic conditions improve and the economy is growing, right? We're adding population, we're adding all of that. And so equities over the long term are a very good story. That's Warren Buffett classic long-term investing. But you also want to focus on our key long-term signals. And this dotted green line, which is a trend line connecting the highs in 2022, maybe, in my opinion, the most important thing to watch here going forward. I've gotten a lot of questions here recently from media outlets, from a lot of our viewers, and my premium members at Market Misbehavior in our conversations. You know, what would tell you that a bottom is in and that the market's going to recover? And a lot of people, right, as we've stabilized around 3,800, is that the new low? Should I be buying this? And my comment is, you certainly can, right? You're able to do whatever you like with your capital. But in my opinion, for me to be convinced that things are really improving, right? It's not just could they improve, but are you actually seeing evidence? Are you seeing confirmation that the markets are improving? They need to be able to follow through to the upside, right? Think of a chart like Alta. And again, not to just pitch Alta as the number one idea in the world, but this is a stock that just happens to be making a new 52-week high. While the S&P is languishing down at 3,800, you have charts like Alta and TRI and others that are breaking above resistance. So the charts are out there. So what would you need to see to get that sort of feeling of bullishness about the S&P? And for me, it is very, very simple. This trend line has been a great measurement, a great visual representation of the pace of the decline in the markets from January 2022 to where we're at now in January 2023. At some point, I would say without a doubt, the S&P is going to go back above that trend line. I don't know if that's going to happen in a week or two or in a year or two, but I know at some point, overall, the S&P tends to be in a bullish phase, and before all is said and done, the S&P will be back above 5,000. I would imagine at some point in the future. To get to 5,000, though, you first have to get above this trend line. And that's the thing you need to remember, right? Before you can make new all-time highs, before you can have a broad recovery in technology and consumer discretionary that would fuel our growth-oriented benchmarks much higher, you have to get above that first measure of resistance. And that's why I think this trend line may be one of the most important ones to watch. That's really what we talked about in the fourth quarter. That's why these highs in November, December really just made so much sense based on what had happened so far. So trend lines are helpful because once you have a good trend line that measures the trend, all you need to do is wait to see when that trend is broken. That would mean that, if this is a couple weeks out, that means the S&P needs to get above 4,000, but that target will change as the trend line continues to go lower, as the market remains below the trend line. So that is one of the more important things I would argue I need to be watching, and I would encourage you guys to watch as well. Second thing I wanted to talk about is just the U.S. dollar. When you think about the dollar index, right? The dollar is important to track for a number of different reasons, right? In 2022, we called the dollar the wrecking ball for risk assets. And that's because if you look at what worked in 2022, right? What was up while the equity markets were down, while the S&P is getting crushed, while the Nasdaq's down 20, 30+%, what is actually working? And the dollar is probably the best example. Certainly energy for part of it, other sectors certainly as well, at times commodities. But overall, the dollar had arguably one of the better years out there in terms of a overall position of strength, certainly in the first three quarters of the year. And the problem when the dollar was so strong, the problem is pretty much everything else was going down. So on a random Friday in 2022, I felt like a broken record of saying the dollar's up, everything else is down. That was pretty common commonly seen in that year. But things really changed in the fourth quarter, right? Look at January through October 1st. And look at October 1st through December 31st. And look at how we had a raging uptrend in the dollar. We had the dollar's RSI remaining above 40, even on pullbacks. We had the dollar above two upward sloping moving averages. All of that changed in the fourth quarter. We now have the dollar below both of its moving average. We have the RSI on the dollar going below 40, which is a sign of danger and telling you that a bull market phase is potentially exhausted. So just like the dollar had been strong, the dollar started to be weaker. Now, what does that mean? Well, that lined up with interest rates coming off because the 10-year yield hit 4.25. It's now down to 3-something. And that pullback in rates, that rally in bonds coincided perfectly with the dollar index coming off. U.S. stocks have been dramatically outperforming non-U.S. stocks. However, that changed in the fourth quarter, right? All of a sudden, you saw markets like Germany and the United Kingdom and France and even Japan, and now China, starting to look a lot better, not just because their price trends are recovering, but on a relative basis, the weaker dollar means the dollar conversion is now a tailwind to non-U.S. positions as opposed to a huge headwind. So this is a key chart to watch. And I think the reason is because it is also testing a trend line. So I feel like so far this is now becoming the trend line show because we're focusing on some of these big important trend lines. The dollar index from mid-2021 to a number of other times later in 21 and early 2022 line up almost beautifully with the lows we've seen over the last couple weeks. Do we remain above this trend line? Does the dollar rally from here? And this all of a sudden was a counter trend move now to the lower end of this trend channel, and we recover and go to the upside. If so, you'd expect rates to probably continue higher, which would make sense, certainly, given what the Fed has described their plans are to continue to fight inflationary pressures. That would most likely mean that instead of non-U.S. markets looking so attractive, they once again have a huge headwind because a stronger dollar means your non-U.S. portfolio is going to be tough because you're going to lose a lot of those returns on the conversion back to dollars. On the other side, if we break below that trend line, all of a sudden the emerging trend that we saw in the fourth quarter would start to continue. That might mean that bonds actually are a much better place to be than stocks, which would be a bit of a change for sure. It could be non-U.S. Stocks certainly have more to go, and that owning developed Europe or European banks or developed Asia like Japan would be a really decent opportunity because the dollar weakness is going to fuel those returns. It's sort of supercharge any returns you have on your non-U.S. position. So I think this is a key chart because it's pulled back enough that we pull back kind of to that final support level. And I'd love to see if we can hold that or not. Just to finish off the charts to watch, I'm going to show a little bit. I actually did my monthly chart review for my Market Misbehavior Premium members. These are my premium subscribers. We have a lot of custom content where we focus on particular ideas. And one of the big takeaways that we had was this set of charts. And I'll just show you briefly. The top series here is the relative strength. This is showing you this sector versus the S&P 500. The rest are showing you the weekly prices and then the momentum as well, but just focus on this top panel. Which of these do you see the trend going up, and which of these sectors do you see the trend going down? Here's communication services. Our next chart is consumer discretionary. Note the shape of that trend over the last 6 to 12 months. Here is technology. Note the trend in relative strength over the last 6 to 12 months. Compare that with consumer staples. There's the trend over the last 6 to 12 months. Compare that to financials. Here's the trend certainly in the last 6 months. Healthcare. Look at the trend in the last 6 to 12 months. And if you see what I'm doing here, certain parts of the market are certainly struggling on a relative basis. And it's the FANG sectors: communication services, consumer discretionary, technology. The problem for our benchmarks is those are the dominant sectors, the mega cap stocks that you know, like Amazon and Netflix and Meta and Microsoft and Apple, are in those sectors. Value-oriented sectors like industrials, opportunistic sectors like healthcare, financials, doing very well on a relative basis. I was taught if you want to outperform the S&P, you need to own things that are outperforming the S&P. That's why we focus so much on relative strength when I was on the institutional side. I think it's a really good lesson for your own portfolio and your clients' portfolios. Those are some of the charts to watch in the first quarter. Again, tune into our Market Outlook special a week from tomorrow, next Friday, where we have a great conversation with some other experts as well and get their take on what is most important for all of you. We need to wrap this show. 30 minutes goes by so quick, but it's time to be done. Let's talk about the 3 and 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. We're focusing on the S&P here, but I'm highlighting 2 particular parts of this chart. Number 1, the 38.2% level is this thick purple line. I love focusing not on a lot of detail. I like simplifying and looking at key levels. If you look at what has happened to the market in the last 6 to 8 weeks, is we have now settled in between 2 levels. We have the trend line connecting the highs from 2022, currently just above 4,000. Also the 200-day moving average right around there as well, and just above there, 4,100. So this range is a clear level of resistance. We have a cluster of resistance. On the downside, 3,800 is the first Fibonacci level. We first reached there May of last year. We're still there. Today, we're actually at that same point. Does this level hold? If so, this can be an encouraging market. If this breaks, though, that's where downside targets need to be potentially thought of a lot more. I also wanted to highlight at the bottom the RSI. Look at in August and September, the extreme swings in price became overbought and oversold. Look now in November, December, January, the extremes in price have the RSI not reaching those levels. We're in a consolidation. We're in a tightening of the range, a coil pattern of sorts. And I am very keen to see which way this breaks. Unclear at this point, but we have clear levels to watch. Chart number 2 is the dollar. In our first quarter charts to watch, we highlighted the dollar as one of the key charts. I think this can tell you a lot about U.S. versus non-U.S., about small cap versus large cap we didn't talk about necessarily, and just the overall conditions for risk assets. See if we're able to hold this trend line. I am not certain we will be able to, and I will tell you, a break below that trend line, all of a sudden you have further downside to be had, and this is the relative strength of U.S. versus global stocks. This line had been going higher for 2021 and most of 2022. The fourth quarter was the first quarter in quite some time that this ratio has had a down quarter, showing that U.S. has been underperforming non-U.S. when you adjust for the dollar. Finally, Ulta Beauty. I mentioned this earlier, and I just put it in the 3 and 3, which is why it was at the top of mind for me. This is not the only stock that is breaking out. And as I reflect on where we're at here in early 2023, and I think about the challenges on the chart of the S&P, I think about the dollar and what that might mean. I think about the Fed and interest rates. Above and beyond all of that, there are stocks that are breaking out, and that is such an important thing to remember. If you invest in individual equities, the really cool thing is there is some stock somewhere that's actually in a pretty good setup. And it's not just Ulta. There are a bunch of stocks in communication services and consumer discretionary and financials and industrials and healthcare that look kind of like this chart that are breaking above recent resistance. Focus on those names and use our scanning engine to make sure you find the right opportunities at the right time. Folks, that is a wrap for the show. It is so good to be back with you live. We are excited for a lot of great content on StockCharts TV and our show, The Final Bar. Keep looking for new improvements to the show here in the coming weeks and months, and we'll be in our studio soon. For StockCharts TV in Redmond, Washington, I'm Dave Keller. Be safe, be well. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.